Hello, everyone. This is Miss Noble, and today we're going. Okay, so again, if we're looking at this sheet right here, what we'll see is that this is John's company, that information about John's company. So on June 30th, 2008, on June 30th of 2008, I should say, this was the value of John's company. John owned assets worth $123,000. His assets consist of, he had $100,000 in cash, he had about $20,000 in different investments, and then he had about $3,000 in supplies. So his total assets were $123,000. On the other hand, John also owed some things. He owed $2,000 in wages, and this is what he owed to probably the people who work for him. He also owed $35,000 to somebody. Accounts payable represents an account that has to be paid at a later date. So this could be a loan, these could be credit cards, but this is something that he borrowed and has to pay back. It's an account that is payable. And so John's total liabilities, what he owes to others, is $37,000. The owner's equity represents the difference between what John owns, and what he owes. Okay, so he owns this amount. However, of this amount, he owes this $37,000 to someone else. So in actuality, the value of John's company, or the net worth of John's company, is $86,000. If we take the $86,000, which represents what John's company is worth, or his share, his equity in the company, we add what he actually owes to other people, we notice that that total is going to be $123,000, which equals the assets, or what he owns in the company. A balance sheet should always balance. What's on the left should balance what's on the right, or if you find a balance sheet in which the assets are listed at the top and the liabilities are listed on the bottom, they should still balance. So a balance sheet must balance. If the balance sheet doesn't balance, that must mean that there's an error somewhere. Okay? Balance sheet. It shows the value of a company, what a company is worth at a given period of time. Moving on. The next financial statement that we want to look at is going to be, let me scroll up some, an income statement. And an income statement basically shows what money a company has coming in for a period of time. It shows what expenses they paid for a period of time. And ultimately, it shows whether or not a company had a profit or a loss. If a company had more money coming in than it had going out, a company is going to have a profit. So if the income is greater than expenses, a company will have a profit. If a company spends more than what it makes, it will have a loss. So if a company has more expenses than income, it will have a loss for a period of time. So now let's look at an income statement. So this is an example of an income statement for a company called Quartz Corporation. And this is for the entire year. And we can fill in whatever year we want to. But for the year, this is what the company did financially. So they earned some money. They had revenue coming in from whatever services that they were providing to the customers, $750,000 worth of earnings. And then they earned some interest, probably on some of their investments or some of their savings accounts. And so they earned $15,000 in interest. In total, the company had income, or had earnings, of $765,000 for the year. Let's just say that was 2019. However, we all know that in order to make money, sometimes you have to spend money. So here are some of the things that the company had to spend money on during this same year. They had to pay the workers. So this is the salary. So they had salaries expenses of $235,000. They had to pay some type of rent, whether it's for the building or something else that they were renting, for $115,000. And then they had some other expenses to keeping the business operating and running of $300,000. So the total expenses, or the total amount of things, the total amount that the company spent on expenses throughout the year was $650,000. So they earned $765,000, but they ended up spending $650,000 to keep the business running. And in the end, they had a net income of $115,000. So again, they made money because they earned more than what they spent. Okay, that's an income statement. An income statement tells you whether or not your company had a net income or a net loss, and it shows the money that a company earned and where it came from, as well as the money that a company spent and what it was spent on. Moving on. Earlier, I told you that there were 4 different account types, or major account types, and they are assets, which are the things that you own, liabilities, which are things that you owe, expenses, which is money that is spent, revenue, which is money that's earned. We also mentioned that there's a difference between a debit and a credit. Debit simply means left, credit means right. So looking at this right here, this just tells you on what side you should see the balance of an account that is classified as an asset account, a liability account, expense account, and a revenue account. And we will come back and look at that into more details at a later time. But just understand those are the 4 major account types, and those represents the type of balance that should be in that account. So a debit is an entry that's made on the left-hand side, and a credit is an entry that's made on the right-hand side. What we see here is an example of something called a T chart or a T account. And a T account is used to summarize or record transactions for each account. So when you think about accounting, again, remember what we're doing is we're recording all of the financial transactions, or all of the things that happen within a company related to money. So if you can imagine, let's just say if you had a, I don't know, for simple purposes, if you had a shoe store, okay? So every time cash is received or someone spends money in your shoe store, then what you would need to do is you would have to record that information in a particular account. So imagine this is the cash account, okay? And so whenever something happens, you would either record it on the left-hand side or record it on the right-hand side. The same thing. Let's just say every time you had to pay an electric bill, you would have an account called electricity perhaps, and then whenever you pay the electric bill, you would have to record that amount either on the left-hand side or the right-hand side. So each business has different accounts that are set up that depends on the type of activity that's happening in a business. Again, this is something that we will go over in a little more detail, but just keep in mind, again, what you need to understand is with accounting, you're just keeping track of what's going on within the business as it relates to the money side of it. Okay, so if we look at this T chart right here, what we're going to do is we're going to look at an example of how we will record in a transaction, a simple transaction. In this transaction right here that we're looking at, we have a situation in which your parents gave you $150, and then you spend $100 of the $150 on clothing. Let me see if I could do this real quick. Okay, so here we have cash is what we're going to be looking at. Cash would be an example of an asset account because cash is something that you own. Asset account, cash. For asset accounts, whenever the account increases, you would record the transaction on the left-hand side. If there is a decrease in that particular account, then you will record that information on the right-hand side. So in this example, we have cash, $150 that we received. So what happens to our cash balance when we receive that $150? It increases, which means we would record that $150 on the left-hand side of this particular T-chart or in our cash account. However, when we spend $100 of this $150, of course, this balance is going to go down or decrease. And so that $100 that we spent is going to be recorded on the right-hand side. So now what we have to do is figure out what is the balance of our cash account. Well, we take what we receive and we subtract out what we spent, and we should get that the balance of our cash account is now $50, and that $50 balance would be on the left-hand side. This is just a simple example of how accounting works. Again, all we're doing is we're recording every time a business has some type of transaction, whether they're making a sale or paying a bill or buying something new or paying off a bill. They have to record that information, and that information can be recorded in a T account. And all you do is make sure you record any increases in the account, you record any decreases in the account, and in the end, you just want to know what is the balance of your account. And that balance will either show up on the balance sheet, like the one we looked at earlier, or the income statement. Okay, so now what I want you to do, now that we have a brief overview of accounting, and hopefully we understand that accounting is just a system of just recording what's happening within a businesses regarding their finances, what I would like you to do is to complete this activity. I mentioned to you before that with accounting, there are 4 major account types, okay? A business is always going to own something, and those are called assets. They're always going to owe somebody. That's going to be called a debt or a liability. Businesses always spend money on bills and have different costs to keep the business running. Those are called expenses. And then they also have money coming in because that's the reason why they went into business. That is called revenue. So what I would like you to do is to make a list of 5 assets that a person or a business could own. I want you to find at least 3 examples of a liability. What are 3 things that a person may owe somebody for that they will have to pay off eventually? So think of something, a reason why a company may borrow money or why an individual will borrow money, and write those things down. Okay, I'll give you an example. For instance, if a company or a business have a credit card, that will be a liability. Okay, so think of something, a debt that someone may owe or a business may owe that they have to pay off at some point. Don't get that mixed up with expenses. So an expense would be something like a light bill or water bill. That's a cost, something that you pay over and over again. A liability is going to be something that you owe, but once you pay it off, you don't have to pay it again. That's the difference between a liability and an expense. Okay, so find 5 types of expenses a business may have to pay or an individual may pay over and over and over again. And then I want you to think of 2 different ways that a business could earn money. Okay, so make a list of those things. And then what I would like you to do is to create some type of presentation. It says a PowerPoint on here, but you can create a poster or whatever that shows each of your different account types: assets, liabilities, expenses, and revenues. And then I want you to list each of those things and then find a graphic or image that matches the items on your list. Okay, that is accounting activity number 1. Accounting activity number 2, we're not going to do so much because of the fact that you are doing 1 and 1 includes revenue and expenses. So what I would like you to do is focus on completing that particular activity. And then if you have any additional questions about accounting in general, reach out to me and I will do my best to kind of provide a better explanation to you. All right, that's it for now.